Welcome to the CPG Guys podcast. Your hosts, Shri Rajagopalan and Peter V.S. Bond, explore how brands and retailers engage consumers in an increasingly digitally driven world. And now, here are the CPG Guys. Hello and welcome to the CPG Guys podcast. I'm your co-host, PVSB, and when I'm not co-hosting this podcast, I serve as head of industry and client engagement at Flywheel, the e-commerce accelerator division of Omnicom. My co-host, of course, he's the chief revenue officer at Think Blue Consulting. He is the patriarch of the Raj family media empire, and of course, the former chief customer officer at General Mills. Of course, I'm talking about my BFF Shri. He and I were recently down in Orlando, Florida at the CAGNY, Consumer Analyst Group of New York conference. While we were there, we had the pleasure of recording this episode with one of our favorite analysts. Before we get to that, I'll make mention of the fact that if you follow us on Spotify or Apple, please give us a rating. Our favorite number is 5. Seriously, though, the rating helps feed the algorithm, makes our podcast more discoverable. If you're not following us, please do. We really want to make sure that our episodes appear to you on a frequent basis, and the best way to make sure that happens is to subscribe. So, on to our main episode. We were very pleased to have join us our friend Nik Modi from RBC Capital, talking about what we were hearing at CAGNY conference and the general state of CPG from an investment perspective. I hope you enjoy this episode.
Hi, and welcome to this episode of the CPG Guys, where our guest is none other than Mr. Nik Modi, second time appearance on the CPG Guys, Mr. RBC himself. Industry loves him because he covers many of the publicly traded large market cap brands that we cover on the CPG Guys as well. So we're going to get into all of that on this episode. Nik, first of all, Peter and I want to thank you in a busy conference where you and the company are in very high demand because of what you do here at CAGNY down in Orlando, Florida, or Bonnet Creek to be specific. You made time for us. Thank you for the generosity.
Yeah, you bet. I'm happy to be with you guys.
And so we can't wait to get started. Peter, how you doing, man?
I'm doing great, man. It's good to be here. You and me together again. This is our, second or third event this year already? More to follow.
Fourth, more like fourth.
When we get to the questions, we got a lot of stuff to talk about.
So, Nik, I want to hit up one that's pretty obvious, right? I still remember as a General Mills employee, March 17th, 2023, the world changed from 3 years of record growth, largely pricing and inflation driven, but that was hiding the underlying volume challenges, and you and I have spoken about this many times.
Yep.
So now we're 2 years of lapse, since nearly 2 years when March 17th comes by, and volume trends look flat to decline, as most companies up here on stage have kind of alluded to. What's your outlook? How are you guys looking at it at Wall Street? Volume is a genuine challenge at this point, isn't it?
Yeah, I mean, this has been an area of concern for us going back 2 years, actually. And part of the issue, I think, that's happening, and what I think is maybe short-circuiting some of the big companies, is when prices went up, they breached some critical price thresholds. And as the consumer was feeling, ongoing pressure from inflation and other pressures, they started making different choices. And what was fascinating is that they started to cross category lines. Right, so if you think about it, someone that might have been buying something in the center of the store decided to go to the perimeter because it deflated, right? Whereas the pricing was very sticky in the center. And I remember, and this is going to be like a kind of a hot topic for me in particular because I haven't heard it enough here at CAGNY. But think about eggs, right? And I remember, when the price of eggs went down dramatically after the last avian flu. This was going back a year and a half,
right?
What we saw observably through some of the numerator data, some of the other work that we're doing, is that cereal consumers were buying eggs because they were looking for affordability and trying to feed their families. Now we have a situation where the price of eggs have skyrocketed, but I have not heard a single cereal player discuss that opportunity. And so
this is the problem, Nik?
Yeah, this is the problem. But I think this is a function of legacy consumer insights models that are very category-centric and not occasion-centric.
Yeah, so the follow-up I want to ask you to that is, we've sat through about 9 presentations now, and these are 9 of the largest brands in the world, ranging from annual revenue, like gross revenue of 90 billion and higher to like 5 billion and higher, right? So these are big numbers. And collectively, these numbers could be larger than the GDP of many countries.
Yep.
The talent in these companies still discussing age-old ways of succeeding. Like, Nick, I'm reminded of Marketing 5104 from my MBA class, Philip Kotler,
Yep.
4 Ps. That's what I keep hearing.
We're seeing presentations talking about cutting edge 20th century strategies.
Yeah.
Unfortunately, we're in the 21st century.
So no names, no companies, but overall, when you look at talent, are we getting outdated?
I think so, and it's not necessarily that there's not good talent, right? I just think that there's not good infrastructure, right? And so if you think about the investments in capabilities, they're just either speeding up existing systems, instead of creating new systems. Now, this is hard stuff. And the duration of a CPG CEO, generally speaking, has truncated over the years. So they have less time in their seat. And so it's, the motivation and the incentive to be disruptive, whereas it's over your watch and you might have to deal with some disruption and some dilution of earnings, it's tough. I get it. Like, everyone works on incentives, right? But this is the problem, right? And so, I wrote a piece on Friday coming into CAGNY, and it was entitled "Orlando, We Have a Problem." And really what I argued is that the entire industry should just take a step back on commitments on financial goals, much lower goals.
So well said.
For the next couple of years, and let's reset and let's get ready for the next 10 years.
So acknowledges what you're saying. Don't try and hide it. Don't try and promise something that is not going to happen in the short run. Build for the long term.
Well, I feel like we're hamsters on a wheel right now.
Yeah.
And we're in this rat race too, right? And this is coming from a stock analyst. It's like, stop focusing on the quarters now. It's like, we got some real work to do in this industry, and not every company is built the same. Okay, I'm not going to talk about specific companies, but there's some that are doing it and some that are not, and there are more that are not, right? And that's the issue.
I remember speaking with a chief customer officer at one of the companies that they're not presenting this year, they have in the past. But when asking this person, how do you deal with the quarter versus beyond that, this person said to me, my CFO reminds me that I am responsible for both delivering the quarter and the decade. And that can be a real balancing act sometimes. And right now, what I hear you saying is delivering the quarter. If that's all you're focused on, you're not going to be in a position to deliver the decade.
Absolutely. Like, I think about the marketing model and how it's been flipped on its head.
Yes.
Right? The centers of influence have shifted. It's no longer the companies, informing and influencing.
It's not a
the consumer.
one-way message.
It's not.
Yeah.
It's now peer-to-peer. And just like, follow me on this logic, okay? So marketing as a percentage of sales has been a key metric in the industry for such a long period of time, right? And so
6% is aspirational,
right? And
less than 5 is considered good.
Exactly. And then even some companies, like the HPC companies, are up at 10%, right? Mm-hmm. And the beauty companies are at 20%. But here's the thing: if we can agree, and I think we can, that product efficacy is really becoming the most important thing in brand building because of peer-to-peer selling and so the social selling, which is how brands are being built today, then why is R&D as a percentage of sales so low? Should we see a flip-flop of that? Should the companies be investing more in disruptive innovation and technology? The reason they don't do it and they don't launch it is because it's margin dilutive. And this is the issue, right? This is
absolutely.
the issue.
But let me flip that on its head. Because
unless you're pharma.
We saw a couple presentations yesterday where they had an enormous innovation pipeline. Right. The question becomes, are they expanding their portfolio so much that they have an inefficiency of the ability to generate profitability across a platform? Like we saw, probably the most preeminent performance company yesterday was Coca-Cola. They're having great numbers. They talked very much about refining and simplifying their brands, and that has helped them drive profitability, efficiency, versus these companies that are throwing an enormous number of brands out for innovation. And does that just make their assortment way too inefficient?
It's really a company by company discussion, because it's not just about the innovation, it's also about the execution of the innovation, right? And so let's, take CAGNY, for example. They had, I think, a phenomenal portrayal of where the consumer is
presentation.
going. And I really believe that from a consumer insights perspective, they are, they've always been kind of ahead of
Bob Nolan.
They've been ahead of the
They put someone up on stage,
industry.
not their CEO, not their CFO, to talk about that.
Yes.
That was
And
different
Bob is
than
awesome.
what everybody
Yeah.
else
I
is
think
doing.
that speaks to consumer centricity. However, I think they have too many brands, right? So how can you lean into some of those great concepts and ideas in a much more meaningful way to really drive that, right? Whereas, if you're trying to spread it out over a course of 10, 15 different ideas at once, it makes it a little bit more complicated.
Yeah.
In the Coke situation, this is a fascinating story. And, I get a lot of pushback from Coke on this, but they should be growing much faster than they are, even though they're killing it right now. I mean, I've covered Coke 25 years. I've never seen the company in this good of a shape.
Yeah.
I mean, it's incredible what this management team has been able to accomplish with their bottlers.
Well, they also did a massive reduction in their, they talk a lot about the still portfolio.
Right.
And the importance of it, but they also basically gutted venture and emerging brand group and started to divest themselves of many of the non-carbonated brands that they'd been acquiring over the last 20 years. And that's led to them being successful.
Well, and getting rid of VEB and putting it more in the regions, I think helps because beverages is a very local business.
It is.
Right? But here's the thing about Coke is, and my criticism, right? And again, let me just disclaimer, they're killing it, they're doing well, but I always look at where the opportunities are, right?
Are you the Janet Jackson of CPG?
What have you done for me lately, baby? That's right.
So I don't know.
But let me just finish the thought, right? So Coke has struggled to create a bottled coffee business in the U.S., which is a very fast-growing.
Right.
Yet it's one of its biggest brands in Japan, which is one of its biggest markets, is Georgia Coffee, right? So it's like, when I kind of go around the world and I think of all these amazing white space opportunities for Coca-Cola, how come they weren't first on energy? How come, why are they struggling with Powerade and Body Armor? So it's like there's something in the system that is disallowing Coke from building the next mega brand. And yes, they've built brands and they've moved brands to $1 billion, but I'm talking about, how do you build the next Coke? And the management team would then say, well, you can't build the next Coke. And I think that's the problem. Is that I think they're limiting themselves. Yeah, I think they have a lot of opportunity.
But they have,
Nick,
they've had pockets of success. Like
Absolutely.
look at Fairlife, right?
Absolutely.
They took a category that people thought was mature and flat and nothing was going to change.
Absolutely.
They premiumized a category and drove incredible revenue growth.
Okay, so Peter, here's the question then for Coke, and this is one of the questions I wanted to ask them. What can they learn from the Georgia Coffee experience and from the Fairlife Core Power experience to apply to all these pockets of opportunity they have all across the world?
My own experience from PepsiCo days, arguably it's been 10 years since I left PepsiCo and Frito, on the bottling system, because of the prevalence of the number of bottlers, anytime we wanted to try a new innovation, especially if it was a new subcategory or category, we had to get 107 bottlers a line, and the biggest pushback we'd get is, my truck is already cubed out.
I've got a
You're
certain
asking me
amount of
to
space.
pull out regular Pepsi
Exactly.
to put something new in it, and I'm not incented
And
to
some of
do
those
it.
bottlers carried lines that weren't Coke lines.
Yep.
And that competed with them.
And it was profitable.
And that was kind of why they did the consolidation back in the 2010 era when Pepsi and Coke started gobbling it, but now they're divesting again.
Right.
Well, enough about Coke, because we have 20 other things to discuss
I want
with
to
you
do one
today.
thing.
But
I want to back to the profitability.
Yeah.
We talked about the volume growth. Now we've got, with massive inflation and focus on price points, my question is, how can revenue grow?
Right.
In this,
where's it going to come from?
Where's it going to come from?
M&A?
No. Yes. Yes and no.
Yes
right?
and.
It depends on the company.
Okay.
See,
So it's very company specific.
This is where management capability and organizational design becomes so critical. Okay? So
Well, don't leave that topic. Organizational design. Are you going to get into it?
yes,
Okay.
Yeah.
Let's wait to hear.
So think about just on organizational design, because I think this is really important. When these companies all built their empires, right? They were very consumer centric.
Yep.
And then over the years and decades, they became less consumer centric
As
and
they
more
scaled.
stakeholder centric.
Yep.
Right?
Yep.
When they're investors and the government and society and this. And I understand all of those pressures because I'm part of that constituency, right?
Yep.
So I get that. But I think we need to figure out how to make these companies consumer-centric again. And the one thing that that I think about is how the people closest to the consumer in these organizations are the ones that have the least amount of say. Think about the route drivers or the merchandisers or the salespeople.
Field sales teams.
Yeah. So if
I was talking to a few here who are merchandising rooms, and that's exactly what they said to Peter and me yesterday and this morning. We feel unempowered.
Well, and
all we're given is a playbook and just go execute.
Go execute. And this is the problem, is that, companies have to, even the people on the front lines, they are now market developers. They're not executors anymore.
Yeah.
Because we're in a new world, right?
Yep.
And I speak to, distributors and bottlers and wholesalers all the time, and I say, you guys aren't just about execution anymore. That's what it used to be like. You're market developers.
Yep.
Right? So with AI, why are the companies not enabling their periphery to feed information and let AI help translate the most core ideas that they can be executed upon? So I think the whole decision-making matrix needs a little bit of a fine-tuning.
So it's top-down, not bottom-up, and they're not seeing what their people that are closest to the consumer are seeing.
Yeah, because let's face the facts. Who are the main customers for all of these companies? Who are they?
Everyday consumers.
No,
they're retailers.
They're retailers,
Yeah,
right?
yeah,
So
retailers.
they're not consumer centric.
Merchants, buyers,
right? Yeah,
buyers,
exactly.
Yeah.
So I feel like there
buyers
needs to be,
who actually tell. Again, Nick, I don't want to cloud this conversation with my personal experiences from the last 3 years talking to the chief merchants across the board, but the buyers who have been in positions for 20 years in a category and think they know it all.
right? Correct. And things have changed around them, and that requires a little bit more of a nuanced understanding, which is the people in the field. Now, so like these are tweaks. This is not some like,
Major
oh my
upheaval.
God, how can we change this? And we have to spend all this. No, this is just acknowledging what the issue is that you're actually not as consumer centric as you say.
Yeah.
And I can give you a gajillion examples of that, right? So,
We won't name brands, but I do want to remind our audience, so Nick referred to a white paper at the top of this
We're going to put that
conversation.
in a hyperlink in
It's going to be in the
liner notes
hyperlink,
for
but
this
you can
episode.
also find it on the CPG Guys. Nick has also published another white paper, which is our very next question. You can find that white paper on the private label.
Let's talk about elephants in the room, because there are a lot we're not talking about.
absolutely.
And I think that's the first one, to Shree's point. Private label. Nobody's talking about it. What's the deal?
yeah, I think no one wants to talk about it because it's a problem, right? And
It's a big problem.
it's a big problem.
Tell us what the problem is in your eyes.
Yeah, in my eyes, and this is why we've been writing so much about this topic, and much to the company's chagrin, I'm sure. But historically, look, we know that private labels really hasn't caught sustainable traction here in the U.S. It's not like Europe, right, or even in Canada. Like when I go meet with European investors, like all we do is talk about private label because they see what's going on there. But the European market and the U.S. market are very different.
Yeah, you go to Canada and you see universally across the board one fewer national brand in every category.
Yeah, exactly. So what's going on in private label? Well, and it's all connected to what happened with the inflation. As the inflation went up, as consumers were searching for value.
And there were restrictions on production because of scarcity of resources. So a lot of brands, some brands just did allocation where they said, okay, I'm going to fill retail, my most important retail 100%, and there were a lot of stocks. Other ones said, I'm going to refine my product portfolio and make sure I deliver my core products to everyone. But that left a lot of
open space.
And people couldn't get their brands that they liked. So what did they do? They had to go find other brands.
Correct.
Private label became a viable option for trial.
It did. And that was the issue because some of the quality has improved. And then you have
what happens when a consumer tries private label and they find out the quality is as good or better than the national brand?
It's much stickier.
They have no reason to go back.
Correct. It's much stickier, especially when they're under ongoing inflation duress, right?
Yep.
But then you had Walmart and a couple of other retailers, right, start saying, wait a second, our private label doesn't need to be the cheapest in the store, right? Whereas historically, then price gap management becomes a way for the brands to manage the private label risk. Now we're in a whole new kind of era where the retailers are saying, hey, we're going to launch consumer-centric, unique products for our customers, like Better Goods, as an example. And that changes the whole calculus on how the brands compete. And so I think part of the issue is obviously you're in a public forum and you don't want to be a big CPG company talking about your retailers, right? Because things could get a little messy. So I get that. But the reality is that they need to evolve their private label mitigation strategies because it's not private label anymore. It's retailer brand. Like we need to really delineate private label is one thing.
It's a corporate brand.
It's corporate brand, right? And they have first party data, the retailers that they can use. I mean, when I first started my career, right, it was all the big CPG companies providing all the data to the retailer. Now the CPG companies are buying the data from the retailers. I mean, it's crazy.
Well, not only that, they're buying media.
Right.
And that's another one we didn't hear anything about here, is retail media. Nobody talked about it, but it's the biggest trend in media going on. And the question is, when a retailer gives preference to its private corporate brands on its owned and operated properties, its websites, its mobile app, and then it turns around and it asks manufacturers to buy into retail media to counteract the programming that they're doing on the merchandising side.
That's right.
That's like asking for protection money from a bunch of people from Brooklyn, if you know what I'm talking
That's
about.
That's right.
Right? Isn't that kind of crazy?
It is crazy. And
the one thing that does come to my mind about when he gets to retail media, and I'm thinking private label, private label has the ability to get media for free. Although I hear that that's not the case, I'm concerned that may be the case.
Right.
And I'm going to mix the two of them here. Retail media, no one discussed it at CAGNY. Yet, you talk to every CMO, it's top of mind, the growing budgets and asks are a concern.
Yep.
But I want to come back to private label for one quick second, right? Like no one's addressing it. It's the elephant in the room. You've acknowledged it. It's a problem. You've acknowledged that private label is changing and becoming brands today.
Yep.
But the question I want to ask you is private label more of an opening price point, or do you see a long-term threat to legitimate large market cap brands?
Yeah, I think it's both, right? So that's the thing. It's like, okay, let's just take Walmart as an example, right? They have great value and they have better goods and they have some other stuff in the middle, right? This is what's happening now. And the higher end stuff is very unique, but it's very affordable too, right? So it's bringing excitement that the brands typically bring. Now, I'm not saying the brands are not bringing excitement, because I think there's a lot of innovation that we've seen over the last 2 days where, hey, that's some pretty great stuff. I mean, I had my kids in the, in the conference watching all the presentations, taking notes, and I saw their reaction to certain things. I mean, so it does resonate with the next generation of consumers, but the bar has been raised.
But they also have a choice now with private label, which they didn't previously.
And they have data to inform them on which consumers they need to push to try their private label. And if they convert them, and to your point, with the high quality, now suddenly they are a major threat to the quality consumer that brands had relied upon believing into their brands for years.
And think about how the social media thing affects us. Like, let's take like a company like Elf, for example, where the consumers are showing, right? A company like Elf, the consumer is showing, hey, this product is like this product, but this product is much cheaper, right? Well, guess what's happening all over social media right now with some of these retailer brands? The same thing.
Doing the same thing.
Okay?
Yeah,
and so it's just raised the bar. And again, I think the companies have the resources, the science, the technology to disrupt. There's no retailer or co-packer that can keep up with the R&D functions of these scaled companies.
No.
It's just they're not investing and leaning in it enough.
Yeah.
They're taking a marketing first approach, but they need to take a product first approach.
Yeah. It's a major issue though. Yeah. But one last thing on private label, piece of data that I had access to at least a few months ago. For the first time in history, right? Private label has always been challenged by access to raw material and ingredients because, based on a given commodity, large brands were buying up all the stock in the room to manufacture and grow.
We heard one company yesterday say they control like 40% of the tomato production.
Something like that, right?
In the country. That's enormous.
Wow. And now we're in a world where with volume decline for large brands, private label has unprecedented access to ingredients for the first time. Is that a problem for large brands?
Absolutely. It's a problem for large brands, right? I mean, if you can't secure, enough supply of a certain input, right?
I think the industry is largely ignoring this, not acknowledging it, that in raw material and ingredients is shifting hands for the first time. But enough about private label. Peter and I walked in expecting at least mention of e-commerce and omnichannel, because for many people, many brands, it's the only growth channel left.
It's the only channel that's growing.
Yeah. And you mentioned
growing significantly.
Yeah.
You also mentioned, we live in a world where it's peer-to-peer, which means social is influencing everything, and you can't not have leadership that doesn't understand or isn't really in the middle of omnichannel strategies. We didn't even see a mention. What's going on, Nick?
I'm not sure. I mean, it seems like a big miss. I mean,
were you walking in expecting mentions, or is that phase over for brands?
Well, look, I think, in fairness to the companies, they try to deliver different types of messages every year because they don't want to sound repetitive.
Right.
Now, e-commerce and omnichannel was a big topic over the last few years, right? So in fairness to the companies, I kind of get what they're trying to address.
What excites you this year? What's the big takeaway?
At CAGNY?
Yeah.
Well, I mean, go read that note. We weren't very upbeat coming into it. And
what's the one theme that you say 2 years ago? The one theme was, look, they got their eyes on the ball in e-com, everything from talent to investments to capabilities to retail media. What's the one theme this year? Nothing.
Nothing. And let me just make a point about Omni, because I think this is a really fascinating point. If you look at what's going on with promotions in general, the lift on promos has not been what it, I think, was expected to be and what had been, right? What's going on, okay? Sure, inflation is weighing. I think that's fair, okay? But I think there's something much more nuanced that's happening, which is, if you think about where all the value is being delivered, it's being delivered in digital formats in a much more meaningful way than we've seen historically. However, we've done a lot of work, 60-ish%.
You mean no more paper circulars on Sundays?
Right. But this is my point. If you think about the majority of the buyer, the consumer that is purchasing these products in the store, okay, 60% of that consumption are people over the age of 45. So think about what's happening. I call it the shiny object syndrome. We want to get these next generation of consumers.
But they're not the ones
they're
buying right now.
And you're exactly. So you're not actually delivering the value where the people that need it and
to the wallet that matters the most.
And the people that are spending the most on brands. Yeah.
So again, think about how easy that is to fix. Right?
Yeah.
When I take a step back and I'm like, and I've been very negative on my sector, more so than I've covered this industry for 25 years, okay?
Well, that sends an alert to us that we have an underlying issue.
Yes.
And we're not solving it collectively.
Correct. And these things are easy to solve. It's not like you need to make a massive investment to repivot some of your promotional dollars to your core consumers. Yeah. Right.
And it needs to be in store in that case.
Correct.
Walking through the aisle and the end cap.
Correct.
We talked about the assortment mix and how it has to be, whether it's diluted with profitability or not is dependent upon the company. But what we hear a lot about is, well, we want organic growth, and everybody's talking about M&A, it seems, in these presentations. Are we going to see any organic growth in the next year? Is it a 2 or 3 year down the road before we really start to see, because most of what we're seeing is decline. We had one manufacturer that started off and said, we won't even give you a guidance right now.
Right.
Like, that was pretty bold, not to tell a bunch of analysts.
Walk into CAGNY.
And they won't give you a guidance as to where they're going.
That just shows you the environment that we're in, right? I mean, so look, I think given the state of play right now, it's really hard to envision with confidence we're going to get back to organic growth, right? And remember, a year ago at CAGNY, it's like, oh, look, first half is going to be tough, second half is going to be much better. And we were like, we wrote a note, it's like, people are too optimistic on the back half. And that ended up being the case. We have the same shape of kind of how companies are thinking this year. And that's what I call the Hail Mary strategy. It's like, well, comps are easy in the second half. Let's just get out of this morass and then things will be better. I'm just not willing to bet on that at this point, but we'll track it, and I think it'll be dependent on company to company strategy.
But Nick, comps may be easier because of last year's performance.
Yeah.
But is that the benchmark for looking at growth? Is that the only benchmark you'll look at?
That's kind of where we are right now. Here's my issue, is that the price points, okay, if you go back to 2019, we did this math, and I put out this report a couple weeks ago. you index wage growth for the middle income cohort. So that's the 20th to the 80th percentile.
Okay, so you're taking off the
Right, I'm taking off
deviations,
the very high
tails.
end, which is not as affected, and the low end that saw a lot of wage growth because of minimum wage laws and things like that. The 20th to 80th percentile, if you look at their wage growth index to 2019 versus CPI food, bev alc, and overall CPI, there's a massive gap. Meaning the grocery store,
their disposable income is going more to the grocery store than it did before.
Yes, that and what they're buying day to day has inflated, has become less affordable to them.
Yeah, for sure.
So we did some math. We said, all right, let's just assume the current trend of inflation and wage growth stays where they are, and that's probably not a great assumption given what's been going on with Trump 2.0. If we just hold it flat, the lines will meet again at the end of the year, meaning that the wage growth will have caught up to the inflation. Okay. So here we are. It's either we take corrective action now to get a quicker return to volume, which I do not believe the companies are prepared to do. Some are, others, most are not. Or we just wait it out until the end of the year. Right? And so that's kind of like how you should think about it, right? That's really what's happening. And I just think that these companies need to influence their outcomes a little bit more. And that's why I think the financials need to come down, right? To give them that latitude.
So speaking of financials coming down, EBITDA pretty much consistently, we saw people, volume growth negative, EBITDA decent growth, one even announced dividend increase today. The only way you can do that is cutting costs.
Right.
Having come from practitioner backgrounds, most of these P&Ls are remarkably sharpened pencils. Are layoffs imminent?
Well, they've been going on, right? They've been happening. It's just not being publicized as much as maybe the tech sector or whatever.
Restructuring.
There's a lot of other noise in the ecosystem right now.
And it's happening. Yeah, of course. Yeah, I mean, that's something that's been happening, and I think it'll continue to happen. Just going back to M&A real quick, because you had asked. Yeah. I think we're going to be in one of the most robust M&A environments that we've seen in a long time.
In a good way.
In terms of things happening. Why do I say that? Well, growth is slowing, so obviously, people will look, companies will look to grow. The administration is, I think, going to be much more lenient on bigger deals happening, right? And interest rates have come off their peaks. Right. Yeah. So it's like a really robust. So like I think about like
there's a lot of pent-up frustration. I know on the venture capital and private equity side, those markets have been dead for 2 years.
Correct.
And now suddenly I'm starting to hear, okay, we're open, because if you were a profitable business, you could get PE and VC.
Yeah.
You couldn't if you were burning capital to raise a business. Correct. Nobody could get money. Now I'm starting to hear the handcuffs are a little bit off.
Correct. And so I do think we will see activity in the marketplace. Yeah. And I think about M&A from two different angles. Like I want to see obviously, certain adjacencies being picked up, like, hey, Hershey wants to build its salty snack business. Do they look for a more regional snack player? Right. We won't name names. That would make sense to me. Yeah. But also let's think a little bit more creatively. Like I love what Nike did with Skims, right? Like I love that idea. Like they've never partnered with an outside company, but like that's how you bring consumer centricity to your business model, right? And so I'd like to see more of that.
Skims is also a brand that's very social oriented.
Yeah.
It's peer-to-peer, classic definition of peer-to-peer, and influencers are everyday users on TikTok.
Correct.
Speaking of which, do you think the large market cap brands understand that world to the extent that they need to? They're good at it?
No, they're not good at it. I don't think they understand it.
They're good at Facebook, though.
They're good at Facebook.
I was going to say MySpace. They've got that down. They've got MySpace
Facebook
down.
doesn't exist. It's Meta. That was a joke. But TikTok, back to what you were saying.
So look, this is one of the more fascinating things to me, and something that I've been talking a lot about as I've been making my presentations to the industry. The marketing model has flipped, right? So it used to be that the physical world would inform the digital world. Now the digital world is overwhelming the physical world, but we're not seeing the virality being bought into the physical world.
It's not actually being activated. The opportunities being presented, they're just not activated.
They're not meeting the consumer where they are. And so I'll give you a great example. Yeah. I take the protein Coke, which is basically a combination of a Coca-Cola product, a Coca-Cola with Core Power
That's their shelf-stable
the protein
drink.
Right. And you mix it and they're making dirty
People are
sodas,
doing
right?
that.
And they're making protein Cokes and they're showing their recipes online. And I say to Coke, like, I don't see Core Life vanilla and Coke merchandise together with this moniker.
We're not talking about launching a new product.
Correct.
You're talking about just merchandising two products.
Take advantage of an adjacency.
Another great example is the candy salad. Young people are just buying a bunch of different candies and they're having parties and it's just all mixed together. Candy salad.
Brilliant.
I thought people were trying to avoid sugar.
Coming to a store near you, candy salad.
So why are the confection companies not all over it? I think one company is. Ferrero, I think, is doing some of this, but
I want to go back to an earlier question connected back to this social influence, talent. Here's my own, again, I don't want to cloud this with my own experiences, but sitting in C-suite, talking to C-suite every day for a living last few years, what I'd hear back from CMOs of large market cap companies, I don't have an account on TikTok because the privacy concerns. Right. I didn't know how to respond to that statement. The problem is, if you don't have an account, you don't have to post every day. Most of these people are scared of posting, and I understand. They come, represent large market cap, they have corporate comms, but shouldn't you be following and understanding?
Yeah, I think that's right. And, a lot of these companies have built social selling capabilities or social listening, capabilities, right? So, but if they have all these capabilities, why are we not seeing action?
Yeah,
and
what are you doing?
The problem is companies are overwhelmed with information and they don't know how to process it.
Yeah. Yeah.
I think that is the big problem. It's taking the information and actually activating it, I think, is the issue. Everyone has data lakes.
So that's a problem, though, Nik, because the belief was to be a top dog or be a CEO, you have to come through the system.
Right.
And you have to have experienced sales, you have to have experienced marketing. This worked in the physical world. For some reason, this digital world, that requirement doesn't exist to be a CEO or C-suite. And it's a miss. It's a skill set miss.
It's a massive miss. And then think about the boards.
Yeah.
They're not all
They
consumer
don't have
staples.
anyone to ask the right questions.
Right, exactly. That's why, when I go present to boards,
TikTok on the board? Come on, Nik. They all use it every day.
but when I'm presenting, I do about 5 or 6, board of director presentations for my companies. They ask me to come in for an outside perspective.
Sure.
And, I spend a lot of time on these things, right? I spend a lot of time. And I go in there and I see their faces sometimes and some of the things I'm saying, and it's clear that this is new stuff to them. And so I think that's part of the issue, right? This is why the periphery becomes so important. You already have a built-in advantage of people that are close to the consumer, know what's going on, they're young. Use them.
Yeah. To me, Nik, everything we've discussed, many of these are overcomable. Yes. The one that I really struggle with, again, you referred to the board, we're not going to take names.
Right.
Not going to talk brands here. When your board is outdated with yesterday's skill sets, you have no hope of learning these new ways.
Right.
And you gave examples, you've got social listening platforms. Your board is not interested with outcomes from the social listening platforms.
I'm sure that there were a lot of CEOs up there talking over the last day and for the rest of this conference that talked about things that they have no ability to double click down on, and that is one.
But Nik has just highlighted the issue, though. If your board is not asking you, why should you?
Because they don't know to ask that. Nik, I want to talk about one thing that also we were kind of shocked about. The hottest topic for syndicated market research and consumer insights companies, Circana, Nielsen IQ Numerator, right now, are webinars or presentations around the fundamental impact that GLP-1s are having on volume.
Yeah.
We saw 2 manufacturers refer to GLP-1s here. It's another elephant in the room. What is going on? How are they not talking about how this is transforming their food? I saw one company today talk about, I'm going to take the products that I already have and my innovations, I'm going to glaze them. I'm going to cover them in more sugar.
Right.
Are they just like whistling into the wind? What's going on here?
Well, I think there are a couple things. I have some, I think, more unique views than most on this topic. So let me just kind of go through them real quick. First, GLP-1s is an issue. How big of an issue? I think this is the question. And the reason why I bring this up is because a lot of the studies that have been done about the impact of GLP-1s on consumption were done pre-post at a time where inflation was starting to affect the consumer. So the question becomes, what is cyclical versus what is structural? It's hard to tease the two
Dependent versus
apart.
independent variables.
Correct. Okay. So that's number one. Now, I speak to our biotech team all the time. They cover all these companies that make the GLP-1s. The retention rate on these drugs is very low, 30%.
Yeah.
Okay. Maybe they'll go up over time, but they're very low. So you lose your 25 pounds, you get off the drug, and then, some just don't return, right? So I think there's a lot of debate over the actual impact. That's the first point. The second point is, I think not all companies have uniformly really thought this strategy out on how to respond through their product pipeline. Like Conagra, I think did a phenomenal job. Like, wow. I was wowed, right? Like, I thought they really
knocked it out of the park.
They put their foot forward on it, and I think they really kind of addressed it in a way which is like, hey, even if it's not an issue, people still want protein.
They're putting tags on innovation that says GLP-1 friendly.
But the thing is, it's like, forget GLP-1s, right? Protein is a big thing. It's like over social media, like protein, right? And so they win no matter what, right? Even if GLP-1 doesn't,
absolutely.
They win anyway in that. Now, again, they have to focus their resources, but I think they have the right idea. I'm more worried. I'm less worried about GLP-1s. I mean, I threw the first obesity conference on Wall Street in 2001. That was 24 years ago.
Yeah.
This is not a new topic. One of the greatest new product launches ever in the last 30 years in CPG is Coke Zero Sugar. Okay, it came out of a risk, right? So it's not like the companies are sitting in vacuums either.
Okay.
My bigger concern is the evolution of the wearables market. Okay.
So far, nothing's been done about it.
Nothing's been done, because think about, like, I was wearing a continuous glucose monitor. I was getting real-time feeds on what foods were affecting my sugar levels. These wearables are going to become smaller. It's going to have more ubiquity, and it's going to measure more stuff.
They're going to be in my smart glasses, and it's going to give me those measures like I can't ignore it.
Right. And this is the point, is that we're going to have real feedback on ourselves. Okay? We're going to have real feedback on ourselves, and it's going to inform our choices. And I think this is what the companies really need to prepare their R&D pipelines
Nick,
for.
so you bring back memories of an exciting project I worked on 7 years ago, but we're going to talk offline about it because I had to get in front of Congress on it. But we're going to talk about wearables later. But Nick, I want to wrap this up by asking you a question on geopolitical uncertainty. PepsiCo certainly acknowledged it.
Yep.
We have a very different economic climate, which has shaped up over the last 5 years. We have lots of geopolitical tension and wars emerging and just conflicts all over the place. We have cultural changes, DEI changes coming up in the country. We have a new government, lots of change.
Yeah.
And a regulatory environment which no one knows where it's headed. Thoughts? What are you guys telling brands?
M&A and how that's changing. What are other things that brands are really faced with that they have massive uncertainty about?
Well, this was the whole point of my report on Friday, is that the reason why companies buy these stocks, or investors buy these stocks, is for the consistency. That's why they get premium valuations. Okay? And they have not been able to deliver that consistency because so much has been changing around them. That's why I think they need to really spend time on adjusting business models to make sure that they can really, really manage consistency in this new macroeconomic environment. Because it's not going to change, right? It's only going to get more volatile. We're only going to get more conflicts and more issues that these companies have to deal with. So it's like, make those choices, tough choices now, so you're prepared for the future.
Nik, thanks for taking time to speak with Sri and me at CAGNY. We hope you enjoy the rest of the conference, and we look forward to you coming back on the podcast soon to share your ideas, because it makes my head scratch a lot of these things, and it's good to get a different perspective on this. So
absolutely. Thanks for having me. I appreciate it.
The content in this podcast episode is provided for general informational purposes only. By listening to our episode, you understand that no information contained in this episode should be construed as advice from CPGGUYS LLC or the individual author, hosts, or guests, nor is it intended to be a substitute for research on any subject matter. Reference to any specific product or entity does not constitute an endorsement or recommendation by CPGGUYS LLC. The views expressed by guests are their own, and their appearance on the program does not imply an endorsement of them or any entity they represent. The views expressed by CPGGUYS LLC do not represent the views of their employers or the entity they represent. CPGGUYS LLC expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, special, consequential, or other damages arising out of any individual's use of, reference to, or inability to use this podcast or the information we present in this podcast.